Corporate Finance Excel Practice Problem. In this presentation, we will work a practice problem in Excel related to both balance sheet and income statement classification. Get ready because it's time to take a stance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area in our worksheet on the right-hand side. We have our list of accounts that we're going to be classifying. In the first column, we're going to classify as to whether they are a balance sheet account or income statement account. In other words, these two items are what we will be using to classify. And then in the second column, we will do further classification. If they are a balance sheet account, we will then break it out into the further classification, remembering that within the balance sheet accounts, the balance sheet is the accounting equation, meaning assets, liabilities, and equity type of accounts, which can further be broken out into subcategories, which will include current assets, fixed assets, which are like property, plant, and equipment, or depreciable assets, current liabilities, long-term liabilities, stockholders' equity, none. So we're getting used to basically the classification of these items. On the income statement side, we typically have revenue and expense type items. Those are not included in these classifications. Therefore, income statement items will simply be classified as none. Okay, starting off with the accounts receivable. Accounts receivable, balance sheet or income statement. This is something that people owe us money for, so we made a sale, but the sales side would go to revenue. The balance sheet side would be not cash because we didn't get it, but a receivable. So this would be an increase typically of a receivable. If you think about transactions and effects on transactions, it could be useful for you to kind of figure out where these things lie in terms of the financial statements. Also, of course, when you're working practice problems, if you have financial statements in front of you, even if they're not the financial statements that relate to the particular problem you are working, that's often a useful crutch to be using until you can just basically visualize these items. The practice here is to help with that visualization process as we further classify and get more detailed in terms of that classification. So we're going to say this will be the balance sheet account. Then where's going to be the subcategories? So it's going to be an asset type of account because people owe the company money. They sold something, people owe the company money. It's not cash, but it's still an asset because it represents future earnings that we hope to receive. And we hope to receive them soon, therefore it's going to be a current asset. And I might start grabbing the categories from over here so we can start talking about this further classification. So these groups of items are also included here. So that'll be broken out into our further classification. So then we have, and that's what the first thing I would do, by the way, is if you're verifying this in your mind, is write down the balance sheet accounts and then the classification of these items within it. And that might take some time up front rather than just jumping into a problem like this, but will save time and mistakes as you work through it. Then we've got the retained earnings. The retained earnings is going to be an equity section of the balance sheet because that represents what the net income is going to roll into. It's the earnings that have been retained that we're going to reflect as of a point in time on the balance sheet accounts. So that's going to be a balance sheet account. And then we're going to say that it's going to be within then the equity section. And then we're going to say stockholders' equity is going to be, and that's going to be basically the full equity section, stockholders' equity. Within the stockholders' equity, obviously within any of these categories, we'll have further account classifications, breaking them out, including the retained earnings for the equity and the accounts receivable accounts for the assets. So just note that, again, these are classifications on the balance sheet. This is a further classification, subclassification. Then the accounts, which we have over here, are going to be, within those classified categories. Then we got the income tax expense. Now here, anything that says expense, and not like prepaid expenses, but anything that says expense, then will typically be an income statement item. The income statement really only has income and expense accounts for the most part. And we're not talking about classifications for the income statement. All these items for classification are balance sheet items. Therefore, for the income statement, any income statement item will have none for their classification. Then we've got accrued expenses. Now you might say, hey, what general rule? It says expense here, but this says expenses. Well, it's a little slight different. And this is accrued expenses. So this is not an income statement item. This is going to be something that was accrued expenses, and that's going to be going on the balance sheet. Those are expenses that have accumulated that we have recognized on the income statement, but on the balance sheet we haven't paid for them yet. Cash has not yet gone down. Therefore, we owe cash in the future or something else. We owe something in the future. And so that's going to be a liability. So that'll be a balance sheet account. And it's typically something that we're going to owe in a short period of time. Therefore, it would be a current liability. So it would be a current liability. Next, we have cash. Now, cash is probably the one that's going to come to your mind first because it's like the first thing on the balance sheet. That's an asset, something we owe that we're going to help us use to generate revenue. Therefore, it's going to be a balance sheet item. It's going to be an asset item, probably the most familiar asset type of item. We're going to use it in order to help us generate revenue in the future. Definition, or one definition you can think of an asset, and it will be current because it's the most liquid type of asset that we could have. Then we've got the selling and admin expense. Selling and admin expense. Now, that one says expense and not expenses, and therefore it's going to be an income statement item. So revenue minus expenses, those are the income statement items. And these subcategories represent the balance sheet accounts, not income statement accounts. And therefore, this one's not included in it. So we're going to say none for the subcategorization. Plant and equipment could also be called depreciable assets, could be called fixed assets, could be called PP&E, which stands for property, plant, and equipment. These are going to be asset type of accounts, more long-lived type of assets. So it's going to be a balance sheet type of account. And we're going to say that they're not things that we're going to consume. Even if we purchase them, we don't expense them typically right when we purchase them, even if we paid cash for them, because they're going to be benefiting into the future under the accrual principle. Then we should allocate the use of them, the consumption of them, to the time period that they are benefiting. And they're going to be benefiting many periods into the future. So we're going to be putting them on the books as a fixed asset, which is a type of long-term asset. Then we have operating expenses. So we have, this one says expenses. So you might say maybe, it doesn't say expense because we're talking about multiple kind of expenses in this basically subcategorization. It's a subcategorization on the balance sheet or on the income statement. So it is an income statement item with the expenses because it's a subcategorization. It's not going to be included on any of these categories because those are all balance sheet categories, not like those. So that'll be none then. Marketable securities. Remember, when we're talking about marketable securities, we're not talking about we're our company's stock. We're talking about we purchase stock from another company. And typically when you're thinking about that, we're not talking about a company that is in the business of purchasing and selling stock and generating revenue on income and capital gains, but rather that they just purchase some short-term investment in some other company as a short-term holding spot for the cash that they had until they're going to use it in some future time. Therefore, it's going to be an asset because we're investing in some other company, therefore balance sheet account. Usually it's going to be a short-term because we're just putting our cash there for the short term, not to generate revenue per se, but to get some growth potential in the short term instead of just having it all in cash. But we're going to be using it at some point in the future, typically. Otherwise, it should go to the stockholders. If we're not going to use it, then you would think it should go to the stockholders most of the time, and they can invest it wherever they want from there. The business is in business to generate revenue. So then, increase growth through the generation of revenue. Okay, interest expense. This one has expense on it, once again, so that would sound like an income statement item. So it's an income statement item. None of the income statement items are represented in the subcategory, therefore we're going to say none. Sales, which we could have called income, we could have called it revenue, it could be called, fees earned for whatever type of business we're in. That's our revenue account, revenue classification. That's our major category on the income statement. Notice and get used to the fact that when you're talking about the income statement, you're only going to have like one or two revenue accounts. Usually a lot of times there's one, because you only do one thing. But the revenue account should be big in dollar amount, hopefully bigger than all of the expenses put together. That would give us income rather than a loss. And then we're going to have a whole lot of expense accounts, in other words, because we spend our money on a lot of different things. Hopefully we spend less money or consume less things than we do generate in terms of revenue, but we spend on a more diverse range of things with regards to the money going out or the expenses than the type of things we do for the revenue going in. Okay, so then we're going to say that's going to be, once again, none. Then we've got the notes payable. So that's a payable. Anytime you hear payable, you're going to start thinking liabilities. And liabilities are on the balance sheet. That's what we owe. So that's going to be a liability, balance sheet. Now, a note payable could be long-term or short-term on the balance sheet. Liabilities it's an arbitrary cutoff of 1 year, something that we owe within 1 year. Arbitrary cutoff date, 1 year from this point in time, from the point in time of the balance sheet date. So they're going to have to tell you, is the note payable due within 1 year, in which case it would be current, or over a year, in which case not some kind of non-current or long-term liability. In this case, it's due in 6 months, so it's current. In other words, not all notes payable will be current. Notice I put current asset here, and it should be current liability. I'll pick it up over here. So it's going to be current asset for the rest of the problem, but you want to fix it now to current liabilities. I might remind you again basically at the end of the problem, current liability. Depends on when the note payable is due, and some note payables will have a current and long-term portion. Payables that you're probably used to, such as like a car payment or something like that, where you pay some principal and interest every month, will have both a current and long-term portion to it if the number of payments extend beyond a year or 12 months time. Then we've got the bonds payable. This is another kind of financing. It's a payable. So anytime you say payable, you're thinking liability. Liability is going to be a balance sheet type of account. So we're going to say balance sheet. And unless it says otherwise, I would assume the bond would be long-term. So the bond usually more of a long-term type of an investment, but again, you would need to know whether or not the bond is going to be becoming mature within a year's time period, in which case short-term, or whether it's going to be a long-term type of bond, in which case it would be long-term if it was over a year. So we're going to say this one is going to be long-term. We're going to assume long-term unless told otherwise for the bond. Common stock is going to be an equity section account. Remember, when you think of the common stock, now we're not thinking about us investing in another company. We're thinking about our common stock that our company issued. In other words, it represents the owner's initial investment in the company, because when the owner invested in the company, they did so by giving money to the company in exchange for that ownership represented by the stock. So the stock represents kind of the initial investment on the company side. That's going to be a balance sheet account, represents the owner's claim to the investment or their investment in the company, which means it's the equity section. Owner's claim to their portion of the assets of the company is what equity can be thought of as being. Then we have the depreciation expense. Once again, have an expense in it, and expenses are going to be income statement accounts. Subcategory of the income statement is simply going to be none, because these subcategories all represent the balance sheet. Then we have inventory. Inventory are the things that we purchase that we're going to use in order to help us generate revenue. When we purchase them, we have not yet expensed them or consumed them, therefore cannot expense them in accordance with the matching principle or expense recognition until we consume it by selling it, in which case we expense it in the form of cost of goods sold. Therefore, when we buy the inventory, it's on the books as an asset, which is going to be a balance sheet account. And we hope to sell them soon, therefore it's going to be fairly liquid, so that's going to be a current assets type of account. So current asset type of account. Then we have the capital in excess of par value. Now, whenever you see this account, you want to basically combine it and think, okay, that's kind of linked to the common stock. When the owners of the company invested in the company, they were receiving their investment by receiving basically shares, common stock, into the company. The common stock is usually issued at par, and then the paid-in capital is whatever was invested over and above the par value. So we'll talk more about that later, but you can think about these two accounts basically being combined. They're kind of like one account that got split up into two for various reasons we'll talk about later, but it basically represents the owner's initial investment in the company. Therefore, it's going to be a balance sheet account representing the owner's investment, and therefore it's going to be an equity type of section, and that's going to be stockholders' equity. Up here, I should have put stockholders' equity because that's the categorization they had here, which is equity. And then net income. Net income is going to be on the income statement. It's the bottom line. That's where that double underline goes. We've been saying like income after taxes, but the net income, bottom line of the income statement. So don't get that confused with gross profit, which is a stop along the way. This is the bottom number. That's where we put those two lines to represent the super importance there. And then that's going to be none for the other category, because the categories other than that were all balance sheet categories. And then we got income tax payable. Now we have another payable. Now, anytime we see payable, we're going to think liability. That's going to be a liability type of account, which is a balance sheet type of account. It represents income taxes that have accrued. In other words, we made money and Uncle Sam wants their, and the state wants their portion of it. So anytime we earn money, we owe a payable. We also owe a payable to our silent partner, the government. So that means we have a payable that has been accrued that we have not yet paid. That's going to be a liability. The government usually wants their money fairly soon after we earn it for them. So that's going to go into the current liabilities. And so there we have it. And just going back, we mentioned this as we went, but we did miscategorize the current liabilities here as current assets. So make sure that you have that in place as current liabilities. That should, in other words, be current liabilities.